Hi, this is Ivan Alon, the founder and chief investment officer at Align Wealth Advisors Investment Management, also known as AWAIM. Thank you very much for joining me this month, July. And, today the markets seem to be not so happy with the chip makers. And the NASDAQ is down a couple of percentage points. Draw a underscore under this activity. I might call your attention to a couple of research highlights that had been published earlier. Earlier this month, July 3rd, there was a research highlight published. You can see it over my shoulder here. And specifically, it looks at the Russell 2000 index versus what's going on in the high yield market, and the upcoming Forbes article, which will be coming out in the next week or so, really dives into this narrative a lot more thoroughly. But essentially looking at small cap stocks and how most small cap stocks are rated below investment grade in terms of their bond issues, meaning most of them issue junk bonds. And the junk bond market are basically saying two completely different things. The total return for the high yield market or the junk bond market has been positive over the past 3 years to the tune of about 5%. Meanwhile, the small caps, up until just about a week ago, they were down about 7.5% total return. So, and this is looking at the Russell 2000 index versus the Bloomberg Corporate High Yield Index. That's correct. But I was looking at the BB rated corporate bond effective yield, comparing it to the earnings yield, which on the Russell 2000 index, which has been higher than the BB effective yield as of essentially July 5th. So that's a very interesting research highlight to check out if you have a moment to do so. And the other one is looking at our most recent podcast, Deep Economic Thoughts. And there was one published in June on the 24th, and the title is the AI Bubble Bursting? Well, if you look at today, it may seem like it is and has been. And on July 10th, I recorded high yield or small caps, which market is assessing forward-looking risk best. So these are forecasting and having an outlook and developing an outlook in the capital markets is definitely art, but there's also science, there's math, there is a diligence and a discipline that's engaged in order to develop an opinion and have confidence in a particular outlook. And certainly here at our firm, we've been focusing quite a bit on fundamentals and just looking at basic fundamental relationships, whether it's earnings yield data, whether it's option-adjusted spreads on high yields versus risk-free rates like U.S. government bonds. These things tend to broadcast a particular sentiment, a particular bias in the markets and with market participants. Also, it can indicate a particular euphoria and excitement for a particular new innovation like AI, which of course I think over the coming decades can be incredibly powerful in total factor productivity within an economy. But it's going to take some time to get there. And that's perfectly okay. It just means don't overpay today for the innovation to productivity and the addition to efficiency in our economy that's going to happen 15, 20 years from now. And maybe the current market situation is digesting some of that. Maybe not. Maybe it's just a temporary repricing and pullback before it runs off again. But we tend to stay in the camp that the markets do subscribe to mean reversion, and there's been quite an overextension in a particular direction for a certain segment of the stock market. And we do see that is reflected in other parts of the capital markets, like the fixed income markets, like the high yield markets. and it's something to be certainly very aware of. And yeah, that's my update for you this month. If you have any questions, don't hesitate to drop us an email at info at alignwealthllc.com. Or you can always visit our website for more information and updates like you see behind me at alignwealth.com, ALIGNE wealth.com. Thank you so much for joining me this month, and hope you found these insights helpful. Take care.